Hey everyone. Since September 21st, when the Federal Reserve commented on raising rates another 125 basis points by the end of the year and indicated that unemployment will need to reach 4.4% in 2023 in order to curb inflation, I've been thinking about two things. First, I think the Fed has pushed us into an inflection point. And second, I think the Fed may be oversteering. Think back a year ago to September and October of 2021. Inflation was already rising rapidly, but the Fed held to its position that inflation was transitory. They kept their foot on the accelerator with quantitative easing until they started to back off in November last year. Even then, they phased it out over a 4-month span. The Fed was holding interest rates down until March of this year. Now they're swerving the other direction. The Fed has made multiple sequential significant rate hikes and they plan more. Are they overcorrecting? Chairman Powell has made it quite clear in his messaging since August. There will be pain. And it appears the message is sinking in. KPMG recently surveyed 400 US CEOs, and while the vast majority of the CEOs believe their prospects are very good over the 3-year horizon, 91% believe the US will face a recession in the next 12 months. 91%. That's a pretty clear margin. In fact, when you look at broader sentiment numbers, the CEO confidence level has been showing a pretty healthy decline. I do need to point out, though, that the CEO sentiment is still much higher than it was when we entered the global financial crisis or the pandemic, but it is still concerning. Small business confidence is also showing weakness, as is consumer confidence. None of them are screaming recession, but they do merit monitoring. The softening is also showing up in recently released economics numbers. The ISM Manufacturing Index fell to 50.9 last week. It's still signaling modest growth, but it's down by about 10 points this year to its lowest level since May 2020. Another number that came in last week, the job openings data, had 1 million fewer unfilled jobs. In July, there were 11.1 million job openings, and in August, there were 10.1 million unfilled positions. It's important to note that there are still about 4 million more openings in the US than there are people looking for work. So we still face a labor shortage, but the market appears to be loosening up a bit. We are not in a free fall or even a contraction, but it does appear that the employment market, like the manufacturing index, is still positive, but not as strong as it was a month or two ago. So where does that leave us, and what's it mean for commercial real estate? The answer depends. A lot of this will be driven by the Federal Reserve. Arguably, the Fed has been oversteering. That implies the Fed will go through with their telegraphed 75 basis point increase in November, unless there are substantive changes in the economic readings. Things like job losses, rising unemployment, falling retail sales, or falling inflation numbers. For commercial real estate, that suggests there will be continued upward pressure on interest rates. But more importantly, falling confidence levels could cause hiring to slow, unemployment to rise, spending to ease back, and companies may reduce their inventory levels. If those things happen, it would weigh on demand for most types of commercial real estate. I'm not sounding the alarm, but a modest recession is becoming increasingly probable and uncertainty is rising. That said, most of the economists that I follow are still suggesting that any impending recession will likely be relatively short and mild. But as stated in the CEO survey I mentioned earlier, the 3-year horizon looks pretty good. That's the big thing commercial real estate investors need to think about, the 3-year outlook. As always, investors need to keep their eyes on the horizon.